Hello and welcome. Okay, let's just jump right in, because today we are going to challenge a belief that so many of us, myself included, have always thought was a golden rule. Become debt-free as fast as humanly possible. But what if that very sensible goal, especially with your home loan, is actually a massive financial mistake? A mistake that could be costing you crores? Just look at this, an emotional tax of 1 to 2 crores. That's a mind-boggling number, isn't it? It's basically saying that the incredible peace of mind we chase by clearing our debts, well, it comes with a ridiculously high price tag. So is this for real? Let's break down the math and the psychology behind this whole thing.
All right, so first things first, let's unpack that really provocative claim. How on earth could you lose crores by doing this supposedly sensible thing? We're about to see why the common wisdom might just not be the wisest way to go.
I mean, let's be real. The dream of owning your home free and clear with no bank calling you up, it's powerful. It's this goal that's so deeply baked into our culture. It just screams security, stability. You've made it. It feels like the most responsible thing you can do. But today, we're going to put that feeling to the test.
And this brings us right to the heart of the issue. It's really a battle that's happening inside our own heads. It's a showdown between two very different instincts. It's emotion versus cold, hard math. You know, it's like you have two competing brains. On one side, you've got the emotional brain. It just hates risk. It wants that feeling of safety, that peace of mind that comes with having zero debt. But on the other side, you've got the mathematical brain. It's logical. It sees opportunity everywhere. It understands the insane power of compounding, and it wants to put every single rupee to work to make you more money. This is the big conflict we all have to figure out. So to give our mathematical brain a little bit of an edge, let's talk about an idea from Rich Dad, Poor Dad, the concept of good debt. See, not all debt is created equal. A home loan, which usually has a pretty low interest rate, used to buy an asset that grows in value, like your house, can actually be a really powerful financial tool, especially when you can earn more on your money somewhere else. And this right here, this is exactly how that tool works its magic. Let's say your home loan is costing you about 8.5% in interest. Okay? But a well-managed investment in the stock market, like an SIP, has historically given returns around 12% or even more over the long term. Now, of course, that investment return isn't guaranteed like the interest you save is, but the potential is huge. That gap, that 3.5% difference, we call that the spread. It might not look like much, but over 20 years, that tiny spread is the engine that can build a massive amount of wealth. Okay, enough with the theory. Let's make this really practical. We're going to walk through a simple scenario to see just how wildly different these two paths can turn out. So picture this. You've got a 50 lakh rupee home loan, and after paying all your bills, you have an extra 20,000 rupees sitting in your account every single month. The big question is, what do you do with it? Let's look at the two options. So path A is the emotional path, right? You take that 20,000 and throw it at your loan. Your guaranteed return is the interest you save, about 8.5%. Then there's path B, the mathematical choice. You just keep paying your normal EMI and you invest that 20,000 in an equity SIP, shooting for that long-term 12% return. Two totally different playbooks. And hey, the result of path A is great. It's predictable, it feels good, you will pay off your loan years early, you'll save a ton of money on interest, and you get to live that debt-free dream way faster. No doubt about it, that is a fantastic outcome. But what about path B? What happens when you let that little 3.5% spread just work its compounding magic month after month for years and years? What's the reward for having the discipline to not prepay? The result, my friends, is a potential corpus of 1.6 crore rupees. Just let that sink in for a second. By choosing to invest instead of prepay, that same $20,000 a month can grow into a massive fortune over the life of your loan. This is exactly what your mathematical brain was getting so excited about. And here is the absolute kicker. At the end of your loan term, that 1.6 crore corpus is more than enough to just pay off whatever is left on your loan in one shot, and you'd still have a huge pile of cash left over. So in a way, your investments literally just bought you your house. It's essentially free. It's wild when you think about it like that. Now, if the sheer power of that math hasn't convinced you to at least think about this, there is one more really important angle to consider. And it makes prepaying look even less attractive from a purely financial point of view, and that is taxes.
So, under the Income Tax Act, you get a tax deduction on the interest you pay for your home loan. This is a huge benefit that lowers your taxable income every single year. So when you rush to prepay your loan, you're not just getting rid of debt, you're actively choosing to give up a fantastic tax break years earlier than you have to. This benefit makes your already cheap loan even cheaper.
So, we've laid it all out. The math, the numbers, the case is pretty clear. But, this decision isn't just about spreadsheets and calculators. It's about what you truly value. This choice isn't about being right or wrong, it's deeply, deeply personal.
So this is the big question you have to ask yourself. Honestly, what's my real goal here? Is it that psychological comfort, that sigh of relief from being debt-free? Or is it the long-term financial freedom that comes from building serious wealth? There's no single right answer for everyone, only what's right for you.
And this question just frames it perfectly. It is a trade-off. Are you disciplined enough? And can you stomach the idea of carrying this cheap, productive debt for its full term so that you can maximize your financial future? Can you let your mathematical brain drive the car even when your emotional brain is in the passenger seat begging you to pull over?
So what do you do now? Well, the goal here today isn't to give you financial advice. It's to give you a completely new way to think about this. First, just be honest with yourself about how you feel about debt. Then, and this is the important part, don't just take my word for it. Go online, search for a prepay versus invest calculator, there are tons of them, and plug in your own loan numbers. Your interest rate, your spare cash, see what the potential difference could be in your life. The answer might just blow you away.